Hey guys, welcome back. Today's video is going to focus on a question that frankly kept me up a little bit last night, doing more research and trying to understand what we saw in the marketplace yesterday when Citibank reduced its price target from $1,400 to $1,150 for Micron. If you guys recall, I covered this article yesterday, and it's based on their analyst said that he attended the 2026 Future of Memory and Storage meeting where he met with supply chain participants as well as third-party experts who mentioned that the pricing momentum for DRAM and NAND is real, but it is fading. In fact, he went on to say that we will see softer pricing environment in the second quarter of 2027. And the thing that confused me the most is I follow this meeting very closely. I watch all of the headlines, the presentations, the innovations coming out of that meeting, and I can find zero concrete evidence that supports this thesis for the Citibank analyst. His name is Atif Malik. He is a very respected analyst across the sector. I'm going to show you his report card in a moment. He covers many stocks and has a really strong track record of performance. But I just don't understand this thesis because honestly, there is a tremendous amount of evidence supporting the exact opposite. Whether you look at all the industry trends, whether you look at the commentary from the executives for these companies, they all mention that 2027 will be significantly constrained for DRAM in particular, more so than 2026. So I just scratched my head trying to understand how he could get to the point where he's going to reduce the multiple from 10x to 8x, which brought him to a new price target of $1,150. And the only thing that I could land on is that is this analyst and is Wall Street, are they looking at one valuation framework for both DRAM and NAND? If that's the case, then this new price target and that valuation framework would be flawed because the evidence is very clear right now that DRAM and NAND, those two memory products, are operating and behaving very differently in the market. We do see softening that could occur with NAND in 2027, but not with DRAM. That market, that product is completely constrained, more so next year than it is this year. So that's the focus on today's video. I want to dive in and dig a little bit beneath the surface for this new price target and show you a little more about the analyst, what his history has been with Micron. I want to show you that there is a little bit of dispute, even within Citi's own research team, regarding stocks and companies within this sector. And finally, I want to spend a good amount of time going through the TrendForce article that was published on July 30th that clearly shows the divergence that's happening in the market right now with DRAM and NAND, because I think that article is the strongest challenge that you could have based on this analyst's argument that we're going to see prices soften in the second quarter of 2027. So that's what we're going to cover in today's video. If you haven't done it already, though, make sure you hit like, make sure you subscribe to the channel. You don't want to miss any future updates that I have. Just like this one, I drop new content each and every day covering this sector, covering all the constraints in the market. So make sure you subscribe to the channel so you can be part of the Market Signal community. Let's dive in and let's talk about the analyst himself. Let me give you a little background on him as well, because I mentioned that his background, it is impressive. If you take a look, his name is Atif Malik. He works for Citi. And if you look on the left side, you'll see that at least according to Tip Ranks, they rank him number 3 out of over 12,000 Wall Street analysts and number 3 out of over 31,000 experts. He covers a wide range of stocks you can see on the right across the entire sector. And what makes it impressive to me, or at least makes his resume impressive, if you look at the two boxes below his picture, you can see success rate of 78%. So out of all the ratings that he has given, 496 ratings, 388 of those have made profit in the last year. In fact, if you just followed his recommendations or ratings in the last year, you would have had an average return of 48%. So guys, that is pretty strong. We have to be very balanced and honest about that. This is an analyst that is steeped into this sector. I just don't understand the rationale that he has for moving the price target down to $1,150. And that's what I want to jump into today's video. But let's first look at his history with Micron. So he started covering the stock, or at least the price target initially in early 2026 that he maintained was $385. And that was based on kind of entering into, the AI enterprise infrastructure build outs being accelerated. And then in March, he moved his price target to 430, and that was right after the Q2 earnings, clearly showing the high demand for Micron's HBM and how it would fit into NVIDIA's ramp with their Vera Rubin platform. And then he lowered it in April to 425. So a very small lowering, about $5, but that was lowered based on just macro-driven fears in the tech sector. But then a significant jump in June to 1,200, driven by DRAM prices, ironically enough. It's the average selling prices going up over 200% for DRAM in June. And it accelerated even further in late June to 1,400 based on kind of robust data center expansions and just a more bullish environment overall. And then finally, we find ourselves now with an 18% reduction in the price point from 1,400 to 1,150. And that is driven down by, in his opinion, a deceleration of DRAM and NAND prices over the next 4 quarters, which potentially could peak in the second quarter of next year. So that's where he stands right now. But I call out that there's a little bit of divergence within Citi's own research team, because these are some stocks that they've recently made movements on. We talked about Micron. SanDisk as well went from 2,500 to 1,200. We're also seeing, Seagate and Western Digital, if I pull that up, they moved those stocks from Seagate went from 1,240 to 1,300, Western Digital 685 to 800. And then we did see some movements with some original equipment makers like Dell and HP. And if you look to the right, it gives you the rationale. So for Western Digital and Seagate, it clearly, the reason Citi's team bumped up those price targets is because of strong AI demand, sustainable pricing power, and tight industry supply discipline from those companies providing the HDDs. So sustainable pricing power for HDDs, which has me scratch my head, because you're giving that category or kind of that stamp of approval to Western Digital and Seagate, but then you mentioned that there's going to be softening in that same environment with Micron and with SanDisk. It almost feels like the Citibank analysts are reading from 2 completely different scripts. If Citi is telling its institutional clients that enterprise server builders, they're roaring with demand, and hyperscalers can't get these products fast enough because the demand is unstoppable, then how can you defend a bear case against Micron and say that there's going to be slowing or softening in the prices? It doesn't align with the overall market analysis or thesis that the entire Citi analyst team has regarding the AI infrastructure build out. And then if you look at Dell and HP, they are claiming, if you look to the far right, it's all based on AI infrastructure growth momentum or demand momentum. And that is accelerating. Again, I would also go back to how Micron fits into that ecosystem as well, because you cannot have accelerating demand with AI server racks without also having significant demand for HBM, DRAM, and SSDs. We know that enterprise memory components make up about 30 to 50% of the total bill of material costs for AI server racks. So how can you say that these companies are driving and their price targets need to go higher based on the demand or what we're seeing, the condition that we're seeing in the ecosystem, but then reduce Micron? So that just didn't make sense to me as well. I think we see a little bit of divergence or debate among their research team. But the biggest article or the biggest factor, I would say, is the fact that DRAM and NAND are operating differently. And my fear is that they're using one valuation framework for these advanced memory products instead of looking at them separately, because they are very different in the market right now. This article is based on TrendForce, their study or their article they put out on July 30th. And I will drop that link in the description below. So make sure you read the article yourself so you can kind of come to your own conclusion as well. But the article says here that DRAM buyers face 2 or more years of scarcity as NAND tilts towards surplus. If we go through some of the high-level pieces of the article, it says the global memory market has split into 2 separate problems. DRAM, the workhorse of AI infrastructure, will remain in a structural shortage through 2028. NAND, by contrast, is on track to flip from a supply-constrained market to a balanced and ultimately oversupplied market by the second half of next year. So let's dig in to explain why. Here's the first part: why DRAM will not ease until 2028. The DRAM shortage is structural, not cyclical, as TrendForce calls out in their article. And it makes clear that new fab capacity alone will not fix any timeline that matters for 2027 planning. The gap is expected to widen further in 2027 as demand growth continues to outpace supply expansion. It's all based on a few factors. HBM is one. We know the HBM penalty, that it just requires more wafer. And you can see here, Micron's wafer capacity disclosures put the figure at approximately 3 to 1. I've seen as far as 4 to 1. And we know that HBM generates 3 to 5 times the revenue per wafer as compared to commodity DDR5. So even if we get new clean room space, even if that comes online, there's still going to be an optimization problem with regards to that new space. HBM pays more per wafer, so HBM gets more of the wafers. They also said that, we do see several DRAM manufacturers, they have initiated expansion plans, but those take time. You have construction schedules, equipment installation lead times, raw material preparation, and it means that we will not see any more bits that come into the market. As they say, we won't see substantial bit contributions till at least 2028. UBS has projected that the global DRAM market will remain undersupplied until at least the second quarter of 2028, not the second quarter of 2027, as the Citi analyst mentions. And this was confirmed by commentary from executives. You can see that the SK Hynix CEO, he went on to say that next year will be the worst year in the industry's history from a supply perspective. Micron CEO confirmed that tight supply conditions are expected to persist beyond 2027. And even AMD's VP said that at the Computex meeting in 2026, that DDR5 prices will not normalize until 2028. Ultimately, guys, AI is not making it any better. The shift towards agentic is not making it better. You see the demand side offers no relief because it is accelerating. We expect global server shipments to grow faster in 2027 and grow faster than the 17% year-over-year rate that was recorded this year. So it is not slowing down. We see that NVIDIA's Vera Rubin platform, AMD's Helios rack, they just have more and more demand for memory. So we're going to see demand continue to outstrip supply next year. And if we jump over to NAND, it says when NAND turns the corner with one caveat. So why NAND is different is that NAND is moving in the opposite direction for a structurally distinct reason: higher layer product migration. Now, they said that NAND, it's primarily expanded its bit output by migrating to denser process nodes rather than building new fabs. And if you scroll down here, you can clearly see new products that have been announced. So SK Hynix, their V8 generation has 321 layers. Samsung's new product, their V9, has 290 plus layers. And Kioxia's BiCS10 has 332 layers, and they're all expected to ramp towards production mainstream next year. The layer migration-driven bit supply growth that we see with NAND right now, combined with the gradual ramp-ups of their new fabs, it's expected to drive substantially stronger NAND bit supply growth in 2027 versus this year. So TrendForce projects that NAND sufficiency ratio will turn positive next year. It'll make that transition from supply constrained to balance and ultimately oversupplied. Very different than we see with the DRAM market. These products are operating completely different and behaving different in the market. Now, the caveat they do lay out is around agentic AI. They say that need to be careful with this because the NAND surplus is not guaranteed. As we shift into the agentic AI adoption, it could significantly increase the demand for high-speed SSDs, which would absorb the incremental supply and pulling the NAND market back towards equilibrium or maybe even into a deficit again. So that's one thing they say we just have to keep our eye on and be careful of. But buyers in the market, what they should do now, they say that, it's that in the second half of that we move into the next year, the fulfillment rate will potentially fall to about 60% range in 27 for DRAM. And we know SK Hynix, they mentioned that their entire 2026 HBM, DRAM, and NAND production was sold out before the year began. Micron also committed that their HBM capacity for 25 and 26 was sold out before the year arrived. So look at the article I want to pull up here. It is clearly showing us that memory makers have sealed the deal for 27. There's no more room for new buyers. According to DigiTimes, industry experts are now claiming that the entire memory production for 2027 has been fully booked, well ahead of the schedule that the industry expected. So the big three, SK Hynix, Samsung, and Micron, they have sold out their memory capacity for the coming year. There is no room for additional supply for third parties to purchase DRAM wafers. So guys, it's just showing you the amount of constraint that we see for next year. They are sold out of DRAM. I just scratched my head because where does this Citi analyst think that the new supply is going to come from? The new fabs from SK Hynix, Samsung, Micron, even CXMT, they will not be online until late 2028, 2029. There is no more supply coming into the market next year. That's where I don't understand why they're saying we're going to see softening in prices for DRAM. It's going to be as constrained as ever next year. For NAND buyers, it's a different story. It says that NAND buyers, with enterprise SSD needs, the period leading into the second half of 2027 actually represents a genuine opportunity to negotiate favorable multi-year terms for the first time in several years. The only thing that might make that a challenge would be the agentic AI wildcard that I mentioned. But if we jump over to this last piece, which is around the reality that the market is bifurcated by AI, the divergence between DRAM and NAND, it is essentially a reflection of the asymmetrical needs or the asymmetrical demand from AI. HBM and server DRAM is contested at every bit with procurement defined by multi-year agreements, prepayment schedules or structures, and strategic partnerships. NAND flash is serving a broader range of workloads with a more distributed supply that is approaching the other side of the curve. And if you look at just the frequent questions, I think TrendForce lays it out perfectly here. It does not project meaningful DRAM relief until 2028. The DRAM sufficiency ratio relative to the demand is expected to widen further next year before any reversal because new fab capacity is not going to come online and produce anything substantial until 2028. NAND, on the other hand, TrendForce projects that NAND sufficiency ratio will turn positive in the second half of 2027, indicating a transition from supply constrained to balance or oversupplied conditions. But it's not certain, and it says that the agentic AI adoption could absorb the incoming supply. So they want to explicitly flag that in the market as well. But clearly, you can see that they are calling for differences between these two markets. And I think this is the piece that I want to call out for each and every one of you on the video to help you understand that this price movement, or at least the way I look at it, I just can't justify it in my mind to think that pricing is going to get softer in Q2 of 27 because I see no signal that doesn't tell me that the market will not be significantly constrained next year, maybe even more than we saw this year. So let's jump over to one last thing I want to do in the video, which is just kind of looking at other calls from analysts in prior years when they have laid out cases for stocks or downgraded stocks from price targets. And I want to pull this up and I want to clearly say, first off, that this is cherry picking. There's no question about it. I'll be very clear and transparent for that because there are a lot of cases that I could pull up that would show analysts that move prices up and we saw performance go the other way, or would be in line with their movement. But I brought up these three kind of examples because they're right in the memory sector and they're more recent. If we look at Micron in 2026, we saw the analysts, they actually degraded the stock from strong buy to hold based on softness in the DRAM orders and concern that AI-driven DRAM demand was already fully priced in. And what happened is that the stock pulled back. We saw a reduction in the price. But what really happened in the market is that the memory market tightened sharply. Micron's AI memory demand accelerated, and the company now has guided towards quarters of $50 billion quarterly revenue. But in that time frame from March to July 26, we saw the stock appreciate 62%. So the rationale was a real risk, but the impact was clearly overstated by the analyst. The next one you can see is Western Digital, which is early 2024. Now, they downgraded Western Digital, citing kind of worsening conditions and HDD pricing and just the demand was structurally weak. The stock reacted as you would expect and went down negative. But what happened next was that hyperscaler nearline demand, it surged, industry capacity discipline tightened, and the market and HDD pricing and margins expanded dramatically. And in that time frame from early 24 to December of 25, Western Digital appreciated by 303%. So the analysts, they underestimated the power of the AI-driven storage demand and the supply discipline. And clearly that was the wrong call, where they downgraded on worsening conditions. And then finally, Seagate in early 24 as well, we saw the stock get downgraded, citing softening prices and expectations that technology improvements would keep pushing the cost down. The stock got pushed down in response. But what happened next is the HDD supply, it stayed tight while demand from cloud and AI infrastructure exploded. Margins expanded and earnings estimates rose sharply. So Seagate's stock performance in that early 24 to December in 25, it actually appreciated by 232%. So the analysts confused technology cost declines with price collapses. And this has happened in the past as well. Here's a couple more examples I'll quickly go through. But NVIDIA in 2023, this is the fallacy of the peak margin fallacy. So the argument here was that gross margins were unsustainable and they've reached their cyclical peak. But the reality is the stock moved up because the analysts were underestimating the CUDA software ecosystem and how that would create structural pricing power for NVIDIA. Micron back in 2019, the argument was soft smartphone demand would equal a multi-year cyclical glut. But what reality was that the hyperscaler cloud demand, it drove a structural super cycle. The reality was the stock moved in a different direction. And finally, Apple in 2024, the question here is that the China is dead scare, that there was weak China iPhone shipments and it would end an era of growth for Apple. But in reality, what we saw was high margin services and an AI upgrade cycle ignored that. And we saw the stock move up in a different fashion than the analysts called out overall. So these are clearly, like I said earlier, some cherry-picked examples because we could clearly find others that operated in a different manner. And to be fair to Malik, to the Citibank analyst overall, I think it's fair to say that he didn't pull these numbers out of thin air. The real logic behind his downgrade is that Wall Street always trades on the rate of change and not on absolute volume. Even if AI demand stays through the roof, memory stocks live and die by price momentum. If DRAM and NAND prices, if they start slowing down over the next few quarters, even if the prices stay high for the products, but if that acceleration slows down, algorithms will start trimming multiple. So I would think, those are the reasons why I believe that Citi is actually stepping back or move their prices down a little bit. They're not saying that the AI story is over, that the memory story is over. They're saying that the easy money on pricing power may be peaking, and they'd rather compress the PE than get caught off guard later. So in conclusion, I would say, what is the real bottom line that we saw with this? We saw that Citi trimmed their price target from 1,400 to 1,150 based on these concerns around pricing power, particularly around the second quarter of next year. But I hope that TrendForce article that I dropped below and I shared just shows that DRAM and NAND should be valuated differently. They're operating and behaving very differently in the market because we see other Wall Street firms that are looking at the same amount of data, the same kind of data overall, and they're coming to very different conclusions. Bank of America, for example, their analyst, Vivek Arya, he stands firm by Micron's price target of 1,550. And the reason he stands firm is because Bank of America evaluates Micron as a sum of its parts framework. And it recognizes that AI-driven DRAM and HBM, they're premium, high-mode enterprise infrastructure products. They are not low-margin consumer commodities. So if you apply a historically conservative 11x or a 12x multiple to Micron's projected earnings power next year, particularly as HBM4 ramps, the valuation easily defends a share price north of 1,500. So the question I have is Citibank appreciating the true differences between DRAM and NAND in the marketplace right now, or are they treating them as if they're in the same phase of the cycle overall? Because TrendForce in the article I showed you, it clearly showed us how DRAM is locked out, sold out, and undersupplied throughout all of 2027. So in fairness to Citi, they may be right that memory prices eventually decelerate. But the question that all of us have to ask right now is that normalization that they lay out based on this, why they're moving the price target, is that normalization too early? And are they treating NAND, DRAM, and HBM as though they're all entering the same phase of the cycle? Because I think the evidence that I laid out in this video clearly shows that they are fundamentally different. But let me hear from you. What are your thoughts below? What do you think about the movement down to 1150 from 1400? Do you think that NAND, DRAM, and HBM should be evaluated differently, or do you think it should be evaluated as a monolithic group overall? Let me know your thoughts below. Make sure you like the comment, like the video, add a comment, subscribe to the channel, and guys, I'll see you on the next one.